Hi guys, this is Siabonga from Millionaires Journey. Today we are continuing with our beginners trading course. We are almost done with this course, so let's continue. Last week, the last lesson was on continuation pattern. As you know, we have reversal patterns and continuation patterns. So on the last lessons we explained what are continuation patterns, and then we named few continuation patterns like ascending and descending triangles. We then names rectangles, also channels, and then we went on to talk about wedges and how to trade these patterns. So today let's continue and look at how the market works and how the market moves. Basically, we will be looking at short-term trading, also known as day trading, and then we'll also look at medium-term trading, also known as swing trading, and then we'll go on to look at long-term trading, also known as position trading, and then we'll look at some few strategies. But don't go to the market and start trading these strategies, because I will just be doing a little summary on these strategies. So let's continue. Okay, so let's look at short-term trading, or known as day trading. So day trading is a popular trading strategy where you buy and sell a financial instrument over a time frame of a single trading day with an intention of profiting from small private movements. So day trading is whereby a trader opens the trades in the morning and closes them by the end of the day with the hope of making profits each and every day. Day trading is another short-term style, but unlike scalping, you are typically taking one trade a day and closing it when you close the day. So when you are day trading, you are opening a trade for maybe 6 hours or 5 hours, other than scalpers who open trades for like 5 minutes, 15 minutes, or even 30 minutes. As a day trader, your trades run for a longer period of time than scalpers. So these traders like picking a side at the beginning of the day, acting on their bears, and then finishing the day with either profit or loss. So as a day trader, when you wake up in the morning, you decide or you analyze and see that, okay, a Euro USD today will drop. You taking your sell, and then the end of the day you are closing with profit or a loss depending on how a Euro USD moved. They do not like holding their trades overnight. As day traders, or a day trader doesn't hold their trades overnight. They open their trades in the morning and they close them before they go to bed. They are not comfortable with sleeping, with trading, with running trades. Day trading is suited for forex traders that have enough time throughout the day to analyze, execute, and monitor a trade. So day trading is good if you have time to analyze, monitor, and then enter those trades. It's not good if you are busy. You are running a business, you are working, you are a student, a full-time student. It won't be good for you, because as a day trader you have to look at the market each and every 2 hours or 1 hour so that you can get your entries. If you think scalping is too fast but swing trading is a bit slower for you, for your taste, then day trading might be for you. So if you think trading smaller time frames like 5 minutes, 15 minutes, or 30 minutes is too fast for you, and trading 4 hour and daily is too slow for you, then you can be a day trader and trade 1 hour time frame and combine it sometimes with 4 hour or 30 minutes, but mainly 1 hour. So these are the things that you should know before you consider being a day trader. You might be a day trader if you like beginning and ending a trade within a day. So if you like opening a trade and closing it within a day, you might be a day trader. You might be a day trader if you have time to analyze the market at the beginning of the day, and you can monitor it throughout the day. So if you can analyze the market in the morning and monitor throughout the day, then you can be a day trader. You can be a day trader if you like to know whether or not you win or lose at the end of the day. So if you are curious of your results at the end of the day, you want to make money daily, or you want to know your losses daily, then you can be a day trader. You will survive as a day trader. But you might not be a forex day trader if you like longer or shorter trading, short-term trading. So if you like shorter trading or longer trading, then you might not be a day trader. You might not be a day trader if you do not have time to analyze the market and monitor throughout the day. Let's say you are a student, you are running a business, or you have a day job. Then you might not be a day trader because you will end up being fired from work because of looking at the chart each and every minute or each and every hour of the working day. Some things to consider before you decide to be a day trader. Stay informed on the fundamental events to help you choose a direction. You will want to keep yourself up to date to the latest economic news that can make your trading decision at the beginning of the day. So you need to be informed of the news, and you also need to be informed of the latest economic news so that you know whether your pairs will drop or will go up for that particular day. If you have a full-time job, consider how you will manage your time between your work and your trading. Basically, do not get fired from a job because you're always looking at the chart. So if you have a full-time job, you might not be, day trading might not be suitable for you because you have to work and you also have to analyze, you also have to execute trades. So it might not be suitable for you. It might not be a good trading style for you. So day trading strategies. These are the strategies that most day traders use. These are the strategies that I personally use. Types of day trading strategies. Day traders look to maximize profits, maximize intraday profit often. They often use one or multiple So they often use one or multiple of the following day trading strategies. The first strategy that they can use is trend trading. Trend trading is when you look at the longer time frame chart and determine an overall trend. So if you want to trend with the trend, you have to look at the daily or 4-hour to see the direction of the market. Is it going down or is it going up? Firstly, and then once the overall trend is established, you move to smaller time frame chart to look for trading opportunities of that trade. So once you know that okay, the market is going to the downside, you move to 1-hour time frame where you'll be looking for your continuation patterns or your reversal patterns so that you can get to execute trades for that day. First, determine what the overall trend is by looking at the longer time frame. So after you find the longer time frame, you know okay, the market is going down. Now you look for a pattern to validate your trade, because you don't just jump into a sell because the market is going down. No, you have to be sure of what you are doing. You have to look for reasons and have a backup on why you are trading. You are entering that. Day trading system. Once you determine the overall trend, you can move to a smaller time frame to look for entries in the same direction. As I said, if it's going down, you go to a smaller time frame like 1 hour, 30 minutes, and you look for entries to the downside. It's called multiple time frame analysis. So you are combining time frames. You are combining daily, 4-hour, and H1 to find a the reason for you to enter a trade. That's why it's called multiple time frame analysis. Counter trend trading. Counter trend day trading is similar to trend trading, except that once you determine over a trend, you look for trades in the opposite direction. This one is more like a trend line breakout strategy. So once you find that the market is going up, you are looking for breakouts so that you can catch the new trend. That's counter trend trading. The idea here is to find the end of the trend and get in early when the trend reverses. This is a little riskier but can have huge profits. So waiting for trends to break can be riskier, but they have huge profits because you catch a trend at the beginning of it. And then we have range trading. This is where you trade between support and resistance. You buy the support, you sell the resistance. Buy support, sell resistance. Can also be a day trading system. Range trading, sometimes referred to as channel trading. It is a trading strategy that starts with an understanding of recent price action. A trader will inspect a chart pattern to identify typical high and lows during the day while keeping a close eye on the difference between these points. So as a trader, you are buying the lows and you are selling the highs. So we have day trading, swing trading, position trading, and then we have the strategy, trend trading, counter trend trading, and range trading. These strategies can be used as day trading, or you can use them as a day trader. Now let's look at the medium term trader, also a swing trader. A medium term traders hold position for few days, taking advantage of the fundamental factors. So this is straightforward. Other than day traders, these ones, they hold the trade for a couple of days. Compared to scalping and long-term trading, medium-term trading has the lowest capital requirement. So scalping requires a lot of capital because it's riskier. Long-term trading requires a lot of capital because you're using a higher time frame. But medium-term trading, it doesn't require that much of trading capital. There are few trade opportunities for this type of style. So if you are a medium term trader, you have few trading opportunities because the market doesn't always move. So it takes 2 days, 3 days for a pattern to be complete, and then you have to wait for another day for that pattern to be broken. So that's why I'm saying it takes there are few trading opportunities for this trading style. This type of trading style involves looking at multiple time frame and using technical patterns like channels, wedges. Aside from this, it also makes use of support and resistance levels, trend lines, and pivot points. So when you're using this strategy, you must know how to use time frames, you must know how to use support and resistance, you must know how to use trend lines, and you must also know how to trade patterns. Then you can be sorted as a swing trader. Candlestick formations and again chart patterns are very useful. You also need to know candlestick formations, those candlesticks like pin bar, doji. We have lessons about this. You can just go back, scroll up on our course, and look for this topic where you can learn about candlesticks and how they work. Trade ideas are generated by looking at patterns. For instance, when there's an inverse head and shoulders on the hourly chart, one could trade the breakout by placing an entry order above the neckline. So swing traders use the patterns that we talked about, though head and shoulders, inverted head and shoulders, channels, wedges, triangles. Those are the patterns that swing traders use to get entries. Exit points, stop loss and take profit areas are usually placed as the key level around support and resistance level or psychologically level. So for take profit and stop loss, we are using levels that are clear, like support and resistance, reversal, what, and all those levels. Fundamentals are also taken into account by closing or modifying a particular trade when the economic report was just released or is about to be released. So as a swing trader, you need to know how to use fundamentals, because you can be in a good trade, but when they announce news and you don't know how to use those news, you find the trade going against you and then taking you out with the loss. So that's it about swing trading. Let's look at long-term trading, also known as position trading. Long-term trading, otherwise known as position trading, refers to a trading style in which a trader will hold a position for an extended period of time. A position trader can last anywhere from few weeks to couple of years. So position traders don't mind staying in one trade for months, even years, because it's an investment for them. It's like going to a bank and saying, can I invest 10,000 for 2 years, for 3 years? That's how they are using. Most long-term traders rely heavily on fundamental analysis, as they are mostly concerned with the future outlook of the market. So position traders are concerned, or they are trading fundamentals, because they are looking at longer period of time. They are looking at what would Euro USD do in 1 year, where will be GBP USD be in 2 years time. So position traders look at the future. They are not concerned with the intraday ups and downs, and instead focus on fundamental factors driving the longer term trend. Because of their long term outlook, long term traders would normally look at the daily, weekly, even monthly chart for their analysis. So as I said, they are looking at the longer term. That's why they look at the monthly, they look at the weekly, even the daily. Mostly they don't go to 1 hour, 15 minutes, or 5 minutes. So now I am sure you understand deeply the difference between day trading, swing trading, and position trading. So we can continue to do the few last parts of this lessons. So let's talk about pullbacks. So pullbacks can be used as a strategy. What is a pullback? The price never just follow a straight line, and the price moves on any financial market can usually be described in so-called price waves. The market alternate between bullish and bearish trend waves. So the market doesn't move straight like this. No, it moves like this. These waves, they create a trend. It never goes up straight like this. During an uptrend, the dominant trend waves moves higher. The correction waves represent the move against the ongoing trade. So if we have, as I said, the trend doesn't go like this. So if we have an uptrend, we'll have impulse corrective, impulse corrective, impulse corrective, impulse corrective. So the dominating is the one that is bigger. We don't care about this one. This is where we look for entries, but the main trend is the bigger moves. When trading pullbacks, traders look for these correction phases and then time entries during these phases. So if the price moves up, you're looking for entry at this pullback. And then if it pushes up again, you are looking for another entry when you get a pullback. But if you see a pullback, then it comes and take out this pullback. Now there are chances that the trend has changed and now it's going down because it broke the previous low. The idea is that you want to wait for the price to pull back during an uptrend to provide with a better entry when the market is moving higher and anticipate that the move will continue. You want to enter a trade for the lowest price as possible. So if the price is pushing up like this, you can't just buy somewhere here, but you can wait for price to come back, and then you buy here, and then it goes up with you, and then it come back, you buy here, and then it goes up with you. So that is the idea behind pullbacks. Learning how to trade pullbacks can be a good skill, a great skill as a trader. Pullbacks happen on all time frames. If you learn how to trade pullbacks, you can enhance your skill and find many more high probability trading setups or scenarios. Pullbacks comes in many different forms. So let's look at the 5 most common pullbacks or strategies, if you can call it that. You can call it pullback strategies. So let's look at pullback strategy number 1. Pullback strategy number 1. Breakout pullback. So it's a breakout and a pullback. Breakout pullback are very common and probably the majority of traders have already encountered them. Breakout pullback commonly happen at the market turning point, when the price breakouts of a consolidation pattern, for example head and shoulder, wedges, triangles or rectangles are most common popular patterns. The price is likely to break out and then come back and retest that level. So what happens is that the price entered the triple. So what happens is that the price entered the triple top after a long uptrend. The triple top had a very well defined low support level. The triple top 1, 2, 3. Main traders use such levels main traders use such level to enter their breakout entries. But where they go wrong is when they move their stop loss to break even too soon. And when they pull back, it happens, the market will kick them out. So as you can see here, the price pushed up, and then it got here, it formed a triple top. That's a pattern that we talked about. And then it dropped, and then it came back to the support and made it resistant, and then pushed up. So that's what we call a breakout pullback. It broke out and then it pulled back to the level that it suddenly broke. That's strategy number 1. So it's where a price goes up and create a pattern, and then after breaking that pattern, it comes back and then pushes up. Break the pattern, come back and then pushes up. That's a pullback. That's a breakout pullback. That's a breakout pullback. Let's look at the horizontal steps. During an ongoing training phase, the price will often represent those stepping patterns. This pullback approach is a great addition to a previous discussed breakout pullback. The breakout pullback happens very closely to a market turning point, but if a trader misses the initial entry opportunity, the horizontal step can allow the trader to find an alternative entry scenario as the trade progresses. A trader could also choose to use the stepping pattern to pull the stop loss behind the trend safely. So by stepping pattern, we mean that the price came here, it created resistance and then broke it and then made it support, and then created another resistance and then broke it and made it support, created another resistance and then broke it and made it support. So basically the price is doing this, it's going up in steps. That's why it's a horizontal steps. You can also use this to trade. If you see the market creating, let's say the market moves up and then it started pushes down, you can put your line here, and then when it comes here, it breaks this, you wait for it to come to this level and then look for buy. Remember, I'm just doing a summary of these strategies. We will have videos where we'll be breaking down the strategies, candlestick by candlestick, time frame, all those components that you need to have for a complete strategy. Now let's look at my favorite. This is my favorite trend line. Trend line. Trend line are another famous pullback tool. The drawback is that a trend line often take longer to be validated. Trend line take longer to be validated, but as soon as they are validated, they can be very profitable. Trend line requires 3 contact points to get validated. You can always connect 2 random points, but only when you get the third point you can really look. You are really looking for a trade. You are really looking at the trend line. Therefore, trend line pullback can only be traded at the third or fourth touch. So if you have a price moving like this, and when you put your trend line like this, it connects, you can start looking for sales at your third touch. Even at the fourth touch, you can start for looking for sell. Just like here, you see, there was this. There was the first touch here, the second touch here. You can look for the sell on the third touch, the sell on the fourth touch, and another sell on the fifth touch. So you can get 3 trades and 3 profitable trades by just one trend line. 3 profitable trades by one trend line. Trend line can work nicely in addition to another pullback method, but as a standalone method, the trader misses many opportunities when the trend line is inverted, take longer. So trend lines can be a very good way to trade, but if you're trading trend lines alone, you can miss very good trades because the market takes longer to confirm a trend line. So that's it about today's lesson. I hope the video was helpful. You learned some information deeply about trading styles and strategies. Now, when we go to breaking down these strategies, you will know exactly what we are talking about. Thank you.